Welcome back to REIQA.com Real Estate Education Program. Be sure you started with the welcome video and have already completed sections 1 through 7. In section 8, we will cover all the many different funding sources to acquire properties and go over how to locate them and how to avoid scams. Please subscribe to our channel, like this video, and ask any follow-up questions in the group. Our experienced investors will respond throughout their days to help you. Check out our website at REIQA.com and the links in the description below for more real estate help, tools, and resources. Now, let's begin section 8. In the previous video, we covered the title and closing process. Let's discuss many different funding sources to acquire properties. First, there's using your own cash. Most people do not start off in a financial position to depend on their own cash to acquire properties. But even if starting off wholesaling, you should still be building up your own capital to be in a better position to do deals on your own. Second would be doing a joint venture or JV deal. You partner up with someone who does have capital or better credit with access to funding. Call up legitimately funded investors in your area and say something like, "I'm good at finding discounted deals, but don't have enough funding or credit to close myself. Would you be interested in doing a joint venture on some wholesale deals with me? I'll do all the work, find the deals, and you choose which properties you feel comfortable bringing the funding to close on. After we close, I'll do any needed repairs and clean up the property to bring a better profit for both of us. Then we'll split the profit 50-50 and repeat." If you contacted several other investors, it wouldn't take very many contacts before you had a few key investor JV partners. Third, there's bank funding. Once you have at least 20% down payment and credit to qualify, you can start tapping into bank financing. There are several ways to use bank funding, including conventional mortgages, commercial loans, home equity loans or HELOCs, portfolio loans, FHA, loans if house hacking, or even using 1031 exchanges when selling one property and acquiring another. Most banks will not typically lend on fixer-uppers needing a lot of repairs. That's where private lenders and hard money come into play. Private lenders are just that, private, people you know or meet who have funds available and they're looking to invest to get better returns. Hard money lenders are businesses similar to banks, but they loan based on the property's value and aren't as concerned about your credit. They will loan up to a certain percentage of the A.R.V, and sometimes will also loan on the repair cost, but charge higher rates and fees and shorter terms than banks do. Hard money companies advertise and are legitimate entities. You can find them by Googling hard money lenders in your market or asset-based lenders. Do your research before using any lender. Many are scams. We'll go more into not being scammed later in this video. Another funding source is retirement accounts. You can borrow from or against your retirement account, or if you have a self-directed IRA or solo 401k, you can actually own real estate inside your account. We own many properties inside our Roth and use Neighbors Group out of Colorado to manage our account. There's a link to their information in the description below and on the REIQA website. Another funding source is a life insurance loan, and as long as you repay it, your life insurance cash value continues to grow. The next funding source would be credit cards. I know this sounds crazy to some people, but using zero interest offers can be a great way to stretch your budget. We'll go more over this later in this video also. The final funding resource, and my favorite, would be creative financing. We'll go more in depth on creative financing in a later video. Now let's get more in depth on hard money lenders versus private money lenders. When most people think about hard money or private money lenders, they think of some shady loan shark type guy that you meet in an alley somewhere and hope the cops are not around. However, that's not the case with real estate. Hard money and private money lenders provide much needed funding that makes the real estate community operate. They provide funding on deals where the banks will not lend. What's the difference between hard money versus private money? A hard money loan is an asset-based loan which a borrower receives funds secured by real property. Hard money loans are typically issued by companies who are in the business of lending. They typically will loan up to 75 or 80% of the purchase price and a percent of the rehab costs. Hard money lenders are not set up for your long-term buy and hold needs, but can be used to acquire distressed properties. And once you finish rehabbing the property, a regular bank will typically refinance the loan if you're going to hold it as a rental. A private money loan is the same as a hard money loan, with the exception the party lending the money typically has some relation to the borrower, such as a relative, friend, business colleague, or other private individual who isn't typically in the lending business, but has established enough faith in the borrower to lend them funding. Private lenders will also want a fair rate of return on their capital, but are more open to longer terms and typically lower rates than hard money. Private money can be secured for either rehab projects or for long-term buy and hold projects. Next, let's look at some rules when raising private money. You need to understand them, and also at some point, you may want to become one once you have more capital. There are many rules set by the Security and Exchange Commission, or SEC, regarding raising private capital. Please talk to a qualified securities attorney in your area or your local SEC office. The SEC takes these rules very seriously. Here's 4 main rules to always remember. First, no general solicitation or advertising. This means no advertising period. This can include postings on your website, message boards, newspapers, etc. Second, do not present offers to unqualified investors. You must have an established relationship with them, and they must be accredited or sophisticated investors. Third, never use the term guaranteed. This is a word that can get you into a lot of trouble. As a real estate investor, you cannot guarantee the property or investment's results or performance. Instead, show different scenarios and possible outcomes, but do not guarantee. Finally, always use proper paperwork. Talk to a real estate attorney and make sure you have the proper legal work in place. Some of the common paperwork includes an operating agreement, subscription agreement, and even a private placement memorandum if you are raising bigger amounts of money or combining investors into an investment. There's very minimal risk for hard money lenders or private lenders because they're investing in a first or second lien position tied to a property with an existing value of more than they're lending. So, worst case scenario, they have to foreclose on the borrower and end up with a property typically worth more than they've loaned on it. Next, let's discuss how to get more private money offered to you. The reason why people offer me private money all the time is because everyone I meet knows what I do and that I am successful at doing it. I get asked almost daily, how do I find private money lenders? The first thing I normally do is pull up that person's social media pages to see if they are using their free tools to market themselves and their business to their circle of trust, and the majority of the time, the answer is no. Even some of you who are doing a lot of deals and making some good money still don't use your circle of trust. I do not understand it. It's free advertising. And you never know who has a lot of money just sitting in an account drawing minimal returns, but they do not have the time or experience to invest in real estate. That's the perfect match if you've got good deals and need more funding. Everyone you know should know what you do. You ask anyone who knows me, or even just follows me on social media from other connections, and they know I'm in real estate investing and flipping. Social media is a free tool that everyone should use to help build their business. Just by posting in your social profile what you do and posting about your journey and successful deals can generate interested private investors. Or a post once a week asking for referrals of motivated sellers can generate more deals and potential private lenders from friends, family, and other contacts. Use this free tool. Be proud of what you do. We all have those friends and family members who are negative Nancys and will talk us down or make fun of us for trying to get ahead in life. Well, ignore them and prove them wrong, and they'll be coming to you. Never be ashamed of what you do. We all provide a valuable service to the communities we live in. We help homeowners out of bad situations. We help improve the quality of homes and neighborhoods. We help ourselves and other investors earn better livings. We help create jobs for contractors, title agents, etc., and many times we help new homeowners or tenants into homes, who a lot of times couldn't qualify otherwise. Wear your business and network with your circle of trust. Also, once you're vested in your real estate investing career and start having a lot of extra capital, becoming a private lender for other investors is another source of revenue to consider pursuing. I like to do short-term lending, especially transactional funding or bridge loans for rehabbers or small business owners. You can make great returns and not tie your capital up long-term. Just use caution and properly research anyone before investing. There's always some risk. Let's dive deeper into using zero-interest credit cards to grow your business. I discussed using zero-interest credit card advances to help grow your business a few times over the years, which can be a great source of cheap money for those who have the cash flow to make the minimum payments and pay off the balance prior to the term. Most cards offer promotional zero-interest periods to new members or zero-interest balance transfers and allow you to request a check that can be written to yourself or your business instead of paying another card balance. I used this technique back when I first started and was able to start with an extra $15,000 at 0% for 12 months, which helped me kickstart my journey. They will typically charge a fee of 3 to 5%. But where else can you get unsecured funding at 3 to 5%? Also, you must be able to pay the minimum monthly payments or it reverts back to the regular interest rate. I do not recommend this for those who do not have the cash flow or discipline to make the minimum monthly payments or who cannot pay off the balance in full within the 12-month term. But for those who can, you can obviously turn that money into a lot better return than the 3 to 5% it costs you. After doing this a few years in a row, I built my credit lines up to being able to take close to $100,000 at 0% over 12 months. This is a huge chunk of cheap money to fund additional projects throughout the year. I used this several times when I needed a little more cash for deals instead of using high-interest hard money, and then I pay the minimum payments and pay off the balance in the 11th month. Caution. Again, use caution and only consider doing this if you have the ability and responsibility to make the minimum payments and payoff within the term. Otherwise, you'll be charged full interest, which can be 15 to 30% depending on your card and credit. Also, if you're in the process of getting other bank loans, don't do it because your credit score will dip a little because your credit card usage will jump up and your DTI, or debt to income, will also increase. Now let's discuss how to avoid being scammed by fraudulent lenders. The real estate industry is an extremely profitable industry. Big money equals big opportunities. However, anytime there's big money involved, criminals and scammers will be looking to prey on the naive and use creative ways to swindle money out of victims. It can be difficult to identify legitimate lenders from the bogus lenders. Even experienced real estate investors have fallen victim to funding scams. Here are 3 popular lending scams and ways to avoid being scammed. The first scam is called the upfront fee scam. A lender pre-approves your loan and then asks you to pay a sizable upfront fee. This can be a tricky scam to avoid, but legitimate lenders will have the fees be payable at closing, not upfront, and any funds paid go into escrow. A real lender will happily provide multiple references for loans they have closed. Also, suggest paying the upfront fee to the escrow agent where the contract is being held. The second lending scam is the 100% financing scam. Lenders will claim to offer 100% financing and require you to pay another upfront fee. Rehab lenders typically will lend on the A.R.V. of a property, but rarely more than 70 to 80% of the A.R.V. If a rehab lender is offering more than 80% of the A.R.V., this may be a sign it's a scammer. Some legitimate lenders will offer more, but this is rare, especially if you do not already have an existing relationship with them. The third scam is the bait and switch lending scam. The lender advertises very low interest rates and no fees to bait the borrower. Then right before closing on the loan, the lender contacts you to switch the terms. They know that rather than risk losing a deal, many real estate investors are forced to accept the new loan terms at the last minute. Some additional ways to avoid scams. Do your homework on the lender by searching on popular scam reporting sites such as REIQA.com. Search for bad reviews on real estate forums and other mortgage-related sites. If it's a lender ad on the internet or social media, don't assume it's legit, especially if it's just some individual who reaches out to you unsolicited or is trolling and posting in online group forums for free. One common red flag is when the only contact info they post is a common email carrier, such as Gmail. Scammers will be creative. They may have other scammers who they use as references, and may even have a nice professional-looking website with a company email and their name and profile on the website. It can still be a scam. Bottom line, if it seems too good to be true, it probably is. If you discover a scammer or get scammed yourself, you should always immediately report the fraud to the Federal Trade Commission at ftc.gov and let your friends, family, and other investors know about any real estate scam. That concludes this section. In the next section, we will go in great detail about all the different ways to use creative financing to acquire properties. Please subscribe to our channel, like the video, and ask any follow-up questions in the group. Our experienced investors will respond throughout their days to help you. Check out our website at REIQA.com and the links in the description below for more real estate help, tools, and resources.